Hey, this is Tim, licensed loan officer. And today on this video, we're going to talk about how to become a property investor. And we're going to go over all the different products that property investors use to finance their properties. And I'm going to go over everything from DSCR loans, hard money loans, fix and flips, everything like that. So if you're interested in becoming a property investor, or if you're already a property investor, this video is for you. And this channel is all about for first-time home buyers, current homeowners, people that are interested in building wealth through real estate. So if you're interested in building wealth and becoming rich through real estate, there's a lot of money in real estate. This channel is for you. So I want to get into it. Don't want to waste any time. So I'm going to go ahead here and share my computer screen on my tablet, and then we'll get right into the presentation. All right. So let's find it here. There we go. So as I said, we're going to talk about these DSCR loans today, a fix and flips and rental portfolio. And let's just get right into it. So a quick introduction. Like I said, we're talking about DSCR rental loans. And what that stands for is debt servicing coverage rental, and then fix and flip, or they call them bridge loans, and then a portfolio loan. And another word for all these could be hard money. So sometimes when people say hard money, they're referring to these kind of products right here, because these are also called hard money. And these are different products. And then real quick, just a little bit of information why you will want to work with me, Tim, is that I will educate you. And that's something I'm doing right now with this video, educating you on property investors and all those products. I always address people's concerns and questions. So if you have a question, leave me a comment and I will answer that for you. I like to show people all their options. So I'm going to show you all the different options you have with property investing and how to make money. And then I help people get the home they love without hassle. Okay. There's a lot of lenders out here that will put you through so many hoops to get a home, and you don't have to do this. Okay. And just so you know, if you don't have a property yet, like if you're a first-time home buyer, this video maybe is not for you, because I want you to buy your first home first, your primary, someone to live in it, learn the home buying process. And then after you buy your first home, this would be a good video for you, because now you can go buy another home and be an investor. Okay, so let's get into it. So again, what is a DSCR rental loan? Like I said, it stands for debt servicing coverage rental loan. And then I'm going to read this right here. I'll read this for you real quick, and then I'll go into it more. So a DSCR loan is designed for real estate investors who want to qualify for a mortgage based on cash flow generated. So a normal mortgage, like me, I'm a residential lender. And with a residential lender, we don't qualify you based on cash flow. We qualify you based on your credit, your income, your assets, and liabilities. But these loans, they care more about the cash generated, okay? And it's for people that want to buy an investment property. So this is not for a primary, it's for an investment property. And then the good news with these loans is that you don't have to provide proof of income, no tax returns, no employment information, nothing like that. So that's the benefit of these loans, that they cater to investors, because FHA is for first-time home buyers or homeowners in general. FHA, you can't buy a rental property. Same thing with a VA or USDA loan. Now, conventional mortgage, you can get a second home or a investment property, but with conventional, they just don't cater, because with conventional, you're going to have to qualify with pay stubs, tax returns, all that good stuff. So these loans are sometimes a lot quicker, and they're catered to investors. So that's why we call them hard money lender. And then let's go to the next slide here. So here's some of the loan requirements, okay? Some requirements here. So the interest rates are higher than a normal primary. They are higher, but they can be as low as 6.75%. And that's right now as I'm recording this, June 11th. So whatever the market is, a hard money loan or a DSCR rental loan will be a little bit higher interest rate because there's higher risk. Like I said, they're only giving you this loan based on the cash flow that you can generate. They're not looking at your tax returns. They're not looking really too much at your credit. They want to know how much money can you make. It's almost like a commercial loan. With commercial loans, it's all about cash flow. The bank wants to see your cash flow. That's what they're interested in. And then you can do a cash out refinance with these. You can borrow up to $500K, and usually after 6 months. So normally you can do one, but they want you to have that property for at least 6 months before taking any cash out. And there are some prepaid penalties, okay? If you take out the money before 3 years. So long as if you get a DSCR loan, keep it for 3 years. There's no prepaid penalty. Now, if you need something a little bit shorter than 3 years, then you want to do a different product, maybe a bridge loan or a fix and flip. And then this is called loan to value. So what loan to value is that they want you to leave 25% of the equity in the home. So if the home is, let's just say, worth $100,000, they want you to leave $25,000 to the home. So if you have a property that's worth $100,000, you can borrow up to 75%, and they call that loan to value. And it's good for single family homes, detached PUDs, 2 to 4 units, or multifamilies, and condos, which is really cool. And then they come in different products. You know, you can get a 5/1 ARM, a 7/1 ARM, a 30-year fix, interest only. That's a great one. Interest only. It's just, you know, you can maximize your cash flow and just pay interest, especially if your plan is to eventually sell that. So they have all kinds of options. And I like this too, is that the credit is as low as 620. So as low as 620, you can get one of these. That's really good. Now, ideally, you do want higher credit to get a little bit better interest rate, because the lower your credit, the higher the rate would be. And a higher interest rate could eat into your profit, because you're paying a higher mortgage. You know, your rent is this, so it's less profit. So, and then flexible down payments. You know, some go as low as 15%. Now, remember, you have your down payment plus your closing costs. And then I'm going to get into this one right here, the debt servicing math. I'll get to that in the next slide. Let's go to the next slide, and then we'll get into that. So as I said, remember, it's a debt servicing coverage rental, and this is how it's calculated. So this stands for net operating income. So you have your income. Your income is basically what you charge in rent. So this will be like rent. I don't know why they have it that way, but this is like the formula. This would be rent. If it lets me write on here. Sometimes this tablet does not let me write. Okay, rent. So that's rent. And then sometimes you have other expenses, okay? Other expenses sometimes come with a property. So just to kind of give you an example, you have a mortgage payment right here, mortgage payment of $1,000, and your income, you're going to charge $1,400, and then your expenses. So if you divide down here, made it simple for you. If you divide $1,400 and what you charge in rent by your mortgage payment is 1.4 right there. And most lenders over here, they want that to be over 1. So it has to be over 1. So this could be 1.1, 1. Why does this thing does not work? I'm gonna need your tablet. So as long as this number can be a 1.1 or 1.2, you're good. You know, you're good. So that's kind of how it works. And then what you want to do is look at a property, and then maybe in that same zip code, see what rent is going for, and see if that mortgage payment is less than the rent. And most of the time it's going to be less, but you want it to be as far as you can. And you want to find deals, like find homes that have problems where you can fix it or get it cheap and get it up to code and rent it out. So that's kind of the name of the game. So the long as the rent is higher than the mortgage payment, they will give you a loan. And if you have 620 credit, and that's the beautiful part about this, that there's no limit to how many loans you can get. Some people have 20, 30, 40 properties because they keep, finding properties, fix it up, and then charge rent, and then they'll give you a loan for it. So really good. So I want to talk about who is a DSCR loan for. And I kind of talked about this already. A DSCR loan is a good choice for investors who do not want to provide employment information. And also, if you have any employment, doesn't even matter. So if, they don't even care. It's for investors, freelancers, and self-employed business people. Now, with self-employed business people, a lot of self-employment people like to write off a lot of their expenses to lower their taxable income, which is totally legal. And when you go through a traditional lender like me, we go off of your taxable income on your 1040s. So if your taxable income is low, even though you made more money, we probably can't approve you. But with hard money lenders or DSCR loans, they don't care. They don't look at your tax returns. They don't care about your employment. They care about what is the rent and what will be your expenses, like your mortgage payment. So it's a great option for those that want to invest. Okay. And then what are the steps to get a DSCR loan, debt servicing coverage ratio loan? You want to, step one is, do your research and find one. There's lots of them out there. There's some local ones and there's some big ones. And if you need help, I can recommend one or two for you. And then step two, you want to apply. And before you apply, make sure you have your LLC set up. A lot of them do require that you have an LLC. Again, this is for investing. This is for business. So make sure you have a LLC set up. And then you want to provide some proof of the income you're going to make from the property. So do a little bit of research. And they're going to do their own research, their own appraisal and things like that. But it's good when you apply to give them, as much evidence to make your case to say, hey, I've done my research. This is what rent is in this area. This is how much I need the loan for. And then that's another thing too. You can provide some calculations in a 1003 rent schedule. You don't have to provide that. That's something they can do. But the more information you give them, the better, because it's just going to make the process speed up. And then closing. Next step is to close. Now they're going to order our appraisal, and they're going to do a little bit of stuff on the back end. And then you are going to have to provide a bank statement to show you have money for your down payment. All right. So we're going to talk about fix and flips. Now these are cool. I love fix and flips. Okay. And now a fix and flip is also known as a bridge loan, or you can call it a hard money loan. And these are short-term financing options. It's designed for investors who intend to purchase and renovate a property intentionally quickly and then sell it for a profit. Now with these, you got to find homes that need work. And a lot of wholesalers are out there. So you can find a wholesaler to find you these properties, or go on Facebook groups, or just look around and find either for sale by owners and negotiate with them. And now I like these because it's quicker money. With rental loans and things like that, it's more of a long game. With the fix and flip, you already say, okay, the property is here, but it could be worth X if I fix it. And can I fix it where it makes sense, where I can sell it in that market? So you want to find homes that are already up to code, that are very similar to the home you're working on, with the same square feet, kitchens and bathrooms and rooms, and then see where they are and bring it up to code. And then some of the requirements for a fix and flip, as you see, the interest rate's a little bit higher, or a lot higher here, because it's short term. These are only for 12, 18, and 12 months. And they have higher leverage. So after repair value, that's ARP 75%. And again, credit 620 or higher. No employment information or verification. And here is the after repair down payment, anywhere from 10 to 25%. It really varies on the hard money lender, because hard money lenders are not traditional lending. Traditional lending is like conventional or FHA, VA, and those usually are pretty standard from lender to lender. Now, when you get into fix and flips and hard money lenders, they make their rules because it's their money. So it's good to talk to multiple ones because there's some variation in credit and down payment and loan to value. Now, I want to give you just kind of a quick calculation here to help you understand this. So after repair value is 75%. So let's say a home, after you do all the work, it's going to be worth $175. And you could get a loan amount up to $131, and that will be 75% loan to value. And then let's just get into an example for you now. So let's say an investment property costs $100,000. So it's $100,000. And the rehab to get it up to code and get it to meet all the inspections is $50,000. The total investment to make this home marketable or sellable would be $150,000. So you've done your research, and that's a big part of this is research. You want to do your research. You estimate that you can sell this property for $200,000. So you found a home for $100,000. It needs $50,000 worth of work, and you can sell it for $200,000. So the way the financing will work for this, remember this is ARV, which is after repair value, and that's what they're going to go off of, the hard money lender. They're going to ask you what's the after repair value, and then they're going to compare it to their numbers. So the after repair value for this example is $200,000, and $75,000 is the loan to value. So that's $150,000. Now, they're going to give you a loan for $150,000, but you have to give them $15,000 plus your closing costs. So $15,000 is your down payment. And so this really varies. Sometimes it's 10%, sometimes it can be 15%. Depends on the hard money lender. But normally with something like this, they will do 10% because it has some wiggle room. So with that one, you get a loan for $100,000 plus $50,000. So your loan amounts is going to be $150,000. But remember, you put $15,000 plus your closing costs into this transaction. And then the way that's going to work is that there's draws. So what a draw means is after you complete the kitchen, they may give you your money back like at $10,000. And then they may give you another draw to finish the bathroom, another draw, and then until the project is done. But you're going to make on this deal roughly $50,000. You see how that works? So the key to this is finding properties that are distressed, that need work, and things like that. That's the goal. And then what are the steps to get a bridge loan or a fix and flip? You want to find a hard money lender. That's what you do. You don't go to your bank, don't go online. You just want to type in hard money lender and start looking around for, these kind of lenders. And then you want to apply. Go ahead and fill out the application, upload some income, not income, but, your bank statement to show you have the money to cover, whatever the down payment is. And then submit your property and your rehab budget. So that be really detailed with the budget. Let them know exactly what you need to do to it and provide a lot of proof for that. And then some calculations in comparable homes. So the more information you give them, the faster the process is going to go. The less information you give them, the more work they have to do. So they're going to look at your stuff. And if they like your stuff, it makes sense, they're going to go ahead and give you that money. You can close pretty fast and then close. They are going to order a appraisal. Most of the time they do appraise, the property. They want to see, they want someone to go out there and kind of look at it before they give you the money just to make sure it lines up with what you already gave them. All right. And then here's another one. This is called a portfolio loan. A portfolio loan works like this. So you already have 4 or 5 or 10 investment properties. You can put them all under one loan where you have one easy, simple payment. And a portfolio loan enables a single lender to provide financing for multiple rental properties at once, combining them into a single loan with a single payment. Rental portfolio loans are typically more flexible in terms than traditional blanket loans, offering a flexibility eligibility requirement. These portfolio loans options are offered by private hard money lenders created to meet the distinct demands for real estate investors. So I kind of like this portfolio loan. It's for people that have 5+ properties and they want to put it all into one payment. And because that actually convenient, putting all of it in one, having one payment. And then you have different options. You could do 10 years, 30 years. It just depends. You want to get everything paid off. And it's 75% loan to value, and it's starting at $500,000. So if you have enough properties equaling $500,000, they will do it for you. And did you have any questions? If you have questions, put it below in the comment section, okay? Put it below in the comment section. And I want to thank you so much for watching. And like I said, if you have questions, drop it below. I'm going to make a few more videos about investing because I want to invest. I'm getting into it, and it's just a great way. Real estate's a great way to make money. But if you're new to this, just getting your feet wet, stay tuned to this channel. I'll get you ready and share different things with you. So thanks so much for watching, and I'll see you again on the next video. Thanks.